January 3rd, 2026, 2:30 a.m. While you were sleeping, American helicopters didn't just capture a president. They seized $17.3 trillion in hard assets. The mainstream media called it a rescue mission. The banks called it humanitarian intervention. But the mathematics tell a completely different story. This isn't about Venezuela. This is about you, your savings, your retirement, your future. And if you understand the pattern that destroyed Rome in 476 AD, the Dutch in 1784, and the British Empire by 1967, you know exactly what comes next. Because history doesn't repeat, but it rhymes with mathematical precision. And right now, we're in stage 4. Welcome to Currency Spot. Now, before we dive into the mathematics that your financial advisor won't discuss, I have a simple request for the experienced businessmen and seasoned investors watching this. If you've seen currencies lose their value in your lifetime, if you remember when a dollar actually meant something, if you understand that patterns matter more than promises, do me a favor, hit that subscribe button. Not for entertainment, but because economic literacy is your only defense in what's coming. And one more thing, drop a comment below. Tell me where you're watching from, what country, what city, because what I'm about to show you affects every corner of the global economy. And I want to know who's paying attention. Now, let's talk about the empire cycle no one wants you to understand. On January 3rd, 2026, at exactly 2:30 in the morning, something happened that changed the global economic landscape forever. American military helicopters descended on Caracas, Venezuela. The official story was simple: capture Nicolas Maduro, restore democracy, free the Venezuelan people from tyranny. The mainstream media ran with this narrative for weeks. CNN called it a humanitarian mission. Fox News praised it as restoring order. Bloomberg framed it as stabilizing regional security. But while the headlines focused on one man's arrest, something far more significant was happening beneath the surface. The United States had just taken control of 33 billion barrels of proven oil reserves. At $57 per barrel, that equals $17.3 trillion in hard assets. To put this in perspective, the entire U.S. national debt in January 2026 stands at $36 trillion. Venezuela alone holds enough oil to cover nearly half of America's total debt, if that oil could be instantly converted to cash. But here's what the financial networks won't tell their viewers. Here's the detail that gets carefully avoided in every mainstream business report. This operation wasn't about Maduro at all. This was a textbook resource seizure, the kind that happens at a very specific stage in the empire collapse cycle. Historians who study the rise and fall of empires have identified a pattern, a 7-stage sequence that repeats itself with mathematical precision. It doesn't matter whether we're examining ancient Rome, the Dutch Republic, the British Empire, or modern America. The stages are identical. The order never changes, and the outcome is always the same. Stage 1 begins with sound money, currency backed by real assets like gold or silver. Stage 2 brings military expansion. The empire grows its influence through superior force. Stage 3 introduces currency debasement. The government starts printing money beyond what real assets can support. Stage 4, this is where Venezuela fits. Aggressive foreign resource acquisition. When an empire reaches stage 4, it means the currency is losing credibility. The government knows it, the central bank knows it, and they need hard assets. Real resources to maintain the illusion of stability. Rome did this when it seized Egyptian grain supplies in 284 AD. Britain did this during the Opium Wars against China in the 1840s. America did this in Iraq in 2003, gaining control over 145 billion barrels of oil. And now, 23 years later, America is doing it again in Venezuela. The pattern is undeniable, but stage 4 is not the end. It's a warning sign. Stage 5 brings internal economic disintegration. Prices rise domestically even as foreign resources flow in. Stage 6 delivers either hyperinflation or deflationary debt collapse. The currency dies one way or another. Stage 7 forces currency replacement. The old money becomes worthless. A new system gets imposed, and the general public loses everything held in the old currency. This 7-stage cycle has destroyed 11 major empires over the past 2,000 years. Not one has ever escaped after reaching stage 4. Not one. The Venezuela operation tells us exactly where America stands in this cycle right now. The mathematics are clear, the timeline is predictable, and the outcome is historically certain. Financial analysts at CNBC won't discuss this pattern. Bloomberg reporters won't connect these dots. The Wall Street Journal won't publish the full calculation. Why? Because once the public understands the pattern, once ordinary investors recognize the stage we're in, confidence collapses faster than any military operation can prevent. The empire cycle doesn't run on hope. It doesn't run on political promises. It doesn't run on media narratives. It runs on mathematics, on trade balances, on currency credibility, on whether productive capacity can support monetary obligations. And by every historical measure, America is following the exact same path that destroyed the Roman denarius, that bankrupted the Dutch guilder, that dethroned the British pound. The Venezuela seizure bought time, perhaps 5 years, maybe 10, possibly 25 if the integration goes perfectly. But it solved nothing structurally. Resource grabs in stage 4 never do. They simply delay the inevitable while accelerating the underlying crisis. To understand why this pattern is mathematically certain, to grasp why 17.3 trillion in seized assets will ultimately destroy the American public rather than save them, we need to go back to the beginning. We need to examine stage 1, where every empire starts with sound money and real value, because the foundation determines everything that follows. There's a reason gold has survived as money for over 5,000 years. It's not tradition. It's not superstition. It's not because ancient civilizations were too primitive to understand modern finance. Gold works as money because of pure physics. You cannot print it. You cannot create it from nothing. You cannot debase it without someone noticing immediately. When a currency is backed by gold or silver, when real metal stands behind every unit of paper, something remarkable happens to human behavior. Trade becomes honest. Governments cannot spend beyond their means because the metal supply is limited. Banks cannot create infinite credit because depositors can demand physical redemption. Merchants cannot inflate prices arbitrarily because the measuring tool itself holds constant value. This is stage 1, the foundation phase, and every successful empire in recorded history began exactly here. Rome started with the denarius, a silver coin containing 94% pure metal under Emperor Nero in 64 AD. When Roman merchants traded across the Mediterranean, from Britannia to Egypt to Syria, everyone accepted the denarius without question. Why? Because they could melt it down, verify the silver content, and know they held real value. The Dutch Republic rose to power in the 1600s on the strength of the guilder, a gold-backed currency that financed the greatest trading empire the world had seen. Dutch merchants didn't need military force to dominate global commerce. Their money was simply more trustworthy than anyone else's. Britain built the largest empire in human history on the gold standard. 1 pound sterling equaled a fixed amount of gold. No exceptions, no variations, no government promises required. From 1816 to 1914, the British pound was the world's reserve currency because it represented something real in America. America's rise to superpower status came through the Bretton Woods Agreement of 1944. $35 equaled 1 ounce of gold, period. Every other currency in the world pegged itself to the dollar, and the dollar pegged itself to gold. This wasn't American cleverness. This was America offering the world the same deal Rome offered in 64 AD, the same deal the Dutch offered in 1650, the same deal Britain offered in 1850. Real money, honest measurement, trustworthy trade. But here's where the pattern always breaks. Here's where stage 1 transitions into stage 2, and the seeds of destruction get planted. Military power follows monetary credibility. Rome conquered the Mediterranean because everyone needed denarii for trade. The Dutch dominated the seas because everyone needed guilders for commerce. Britain ruled a quarter of the globe because everyone needed pounds for international business. America inherited this position after World War II, not through conquest, but through offering the most credible currency when Europe and Asia lay in ruins. The dollar became the global reserve because it was backed by gold and backed by the world's largest intact industrial economy. But military dominance creates a dangerous temptation. When an empire controls the world's reserve currency, when foreign nations hold that currency in massive quantities, when global trade depends on that currency's stability, the empire discovers something intoxicating. It can run deficits that would bankrupt any normal nation. It can import more than it exports, year after year, decade after decade. It can live beyond its productive capacity, because foreigners keep accepting the paper currency in exchange for real goods. Rome learned this during its expansion across Gaul and Germania. Britain learned this while maintaining its global empire. America learned this during the Vietnam War. And this is where stage 3 begins, the debasement phase. Rome couldn't afford its legions on multiple frontiers, so Emperor Caracalla reduced the denarius silver content from 94% to 50% by 200 AD. The coin looked the same, the stamp looked official, but half the real value had vanished. Britain couldn't afford World War I on the gold standard, so it suspended gold convertibility in 1914. Temporarily, they promised. The suspension became permanent in 1931. America couldn't afford both the Vietnam War and President Johnson's Great Society programs on a gold-backed dollar. So on August 15, 1971, President Richard Nixon closed the gold window. Temporarily, he promised. 55 years later, That window remains closed. Every empire tells itself the same lie at stage 3. We're different. We're special. Our currency is strong because of our economy, our military, our innovation, our productivity. We don't need gold backing anymore. The world trusts us. And for a while, 10 years, 20 years, sometimes even 50 years, it seems to work. But mathematics doesn't care about trust, and stage 4 always comes next. There's a moment in every empire's decline when the mask slips, when the carefully constructed narrative falls apart, when actions speak so loudly that words become irrelevant. For Rome, that moment came in 284 AD, when Emperor Diocletian's armies marched into Egypt, not to expand territory, but to seize grain warehouses. The excuse was administrative reorganization. The reality was food confiscation to feed an empire that could no longer feed itself. For Britain, that moment arrived in 1839 when the Royal Navy sailed into Chinese waters, not to establish trade, but to force China to accept opium imports. The excuse was free commerce. The reality was Britain needed Chinese silver and tea desperately, but had nothing of equal value to trade except addictive drugs. For America, that moment happened on March 20th, 2003, when cruise missiles struck Baghdad. The excuse was weapons of mass destruction. The reality was 145 billion barrels of oil reserves that Iraq was threatening to sell in euros instead of dollars. And now, 23 years later, January 3rd, 2026, Venezuela. The excuse, democracy and humanitarian intervention. The reality, 303 billion barrels, the largest proven oil reserves on planet Earth. This is stage 4 behavior, and it follows a mathematical pattern so predictable that historians can identify it centuries after the fact. When an empire's currency loses backing, when real assets no longer support monetary obligations, when foreign nations begin questioning whether paper promises hold value, the empire doesn't accept decline gracefully. It doesn't reform its spending. It doesn't rebuild productive capacity. It doesn't restore sound money principles. Instead, it does exactly what Rome did, what Britain did, what America has now done twice in 23 years. It seizes foreign resources by force. The calculation seems logical at first glance. If the dollar is losing credibility, control more oil, force global energy trade back into dollars, extend the petrodollar system's lifespan. If domestic productivity cannot support currency obligations, acquire foreign productive assets, import real value to back paper promises. If other nations are building alternative trade systems, take control of resources they desperately need, force them back into dollar dependence. It's the same strategy every time, and it fails every time, for the exact same reason. Resource seizure treats the symptom, not the disease. Venezuela's oil doesn't fix America's 70-year journey away from sound money. It doesn't reverse the Nixon shock of 1971. It doesn't eliminate $36 trillion in federal debt. It doesn't stop the Federal Reserve's balance sheet, currently at $8.9 trillion, from expanding further. It doesn't restore manufacturing that moved to China over 4 decades. It doesn't repair infrastructure that hasn't seen major investment since the 1960s. What it does is buy time. Iraq's oil in 2003 bought America 15 to 20 years of extended petrodollar dominance. Venezuela's oil in 2026 might buy another 10 to 15 years. If the integration goes perfectly, if political resistance doesn't create endless occupation costs, if global oil demand doesn't shift to alternative energy faster than expected. But even in the best-case scenario, resource grabs during stage 4 create a fatal trap. The empire becomes dependent on controlling foreign assets it cannot actually absorb. Rome discovered this with Egyptian grain. The logistics of shipping, the cost of military protection, the political instability of occupied territories, it consumed more resources than the grain itself provided. Britain discovered this with Chinese opium trade. The Opium Wars generated short-term silver inflows, but destroyed long-term trade relationships and accelerated the pound's loss of reserve status. America is discovering this right now. Venezuela's $17.3 trillion in oil reserves sounds massive on paper, but extracting that oil requires infrastructure investment, $200 to $500 billion minimum. Refining that heavy crude requires specialized facilities, most of which don't currently exist. Transporting that oil requires security, political stability, cooperative neighboring nations. And all of this takes time, 5 to 10 years before significant production increases. Meanwhile, the costs begin immediately. Military occupation, $50 billion per year minimum based on Iraq precedent. Infrastructure development, $20 to $40 billion annually. Political resistance management, incalculable, but historically enormous. Who pays these costs? Not the oil. That's years away from production. Not Venezuela. Their economy is shattered. The American taxpayer pays through 3 mechanisms that most citizens never see coming. Direct taxation increases to fund occupation and development. Inflation tax, Money printing to bridge the funding gap, 4 to 7% real inflation annually, even as official numbers report lower. Opportunity cost. Every dollar spent occupying Venezuela is a dollar not spent on American roads, bridges, schools, hospitals, productive infrastructure. This is how Stage 4 transitions into Stage 5. The empire seizes foreign resources, but the domestic population gets poorer anyway, and that's when the real crisis begins. Every empire reaches a point where the mathematics simply stop working, where the gap between obligations and resources becomes too wide to bridge, where trust evaporates faster than any propaganda campaign can restore it. For Rome, that point arrived around 301 AD. The denarius had been debased so thoroughly, silver content dropped from 94% to less than 5%, that merchants refused to accept it at face value. Emperor Diocletian responded with the edict on maximum prices, government-mandated price controls on over 1,000 goods and services. The penalty for charging more than the official price? Death. The penalty for refusing to sell at the official price? Death. The result? Merchants stopped bringing goods to market entirely. Farmers hid their crops. Artisans ceased production. Within 3 years, the Roman economy had collapsed into localized barter systems. The denarius became worthless. The empire fragmented. For Britain, that point came in 3 waves. 1931, forced abandonment of the gold standard after holding it for 115 years. 1949, 30% devaluation against the dollar overnight. 1967, another 14% devaluation, ending the pound's role as a global reserve currency. British citizens who saved in pounds for their entire working lives watched their purchasing power vanish, not through theft, but through mathematics. The empire could not maintain currency value and empire obligations simultaneously. One had to give. Currency always gives first. America is approaching this same mathematical certainty right now, and the Venezuela operation accelerates the timeline rather than delaying it. Here's why. The U.S. federal debt stands at $36 trillion. Unfunded liabilities, Social Security, Medicare, government pensions, add another $175 trillion in present value terms. That's $211 trillion in total obligations. U.S. GDP, the entire economic output of the nation, equals roughly $28 trillion annually. The debt to GDP ratio, 127%, is already beyond the point where any empire in history has avoided currency crisis. But the truly fatal number, the one that mainstream financial media carefully avoids discussing, is the interest payment. In 2026, the U.S. government pays $1.1 trillion just in interest on the debt. Not principal, not programs, not military, not infrastructure, just interest. That exceeds the entire defense budget. And interest rates haven't even returned to historical averages yet. If rates rise to 6%, which is below the long-term average, interest payments alone would consume $2.2 trillion annually. At that point, the government faces an impossible choice: default on the debt, which destroys the dollar's reserve status immediately, or print money to cover payments, which destroys the dollar's purchasing power gradually. History shows governments always choose the second option. Always. Because default is political suicide. Inflation can be blamed on external factors, pandemics, wars, supply chains, foreign manipulation. But the result for ordinary Americans is identical either way. Their savings, held in dollars, lose value at an accelerating rate. Retirement accounts, 401ks, IRAs, pensions, continue to show numbers on statements, but those numbers buy less every year. Social Security payments continue arriving monthly, but the purchasing power of each payment declines steadily. This is how $17.3 trillion in seized Venezuelan assets destroys the American public rather than saving them. The oil doesn't generate revenue for 5 to 10 years. The occupation costs begin immediately. The gap gets filled with printed money, and every dollar printed dilutes the value of every dollar already in existence. The wealth transfer is mathematical and merciless. Holders of physical assets, real estate, commodities, productive businesses, see nominal values rise with inflation. Holders of paper assets, cash, bonds, fixed income securities, watch purchasing power evaporate. The middle class, which holds most of its wealth in retirement accounts and home equity denominated in dollars, gets destroyed in the transition. This is stage 6, and stage 7 follows with historical certainty. The old currency gets replaced. A new system gets imposed. Rome replaced the denarius with the solidus in 309 AD. Citizens holding old coins lost 95% of their wealth overnight. Germany replaced the Reichsmark with the Deutsche Mark in 1948. Savings accounts were converted at rates that wiped out lifetime accumulations. The pattern is always the same. The empire tells citizens the new currency will be stronger, more stable, better managed. And for the first few years of stage 1 in the new cycle, it actually is. until the next empire starts the same 7-stage journey. The Venezuela operation, 17.3 trillion in seized assets, is not a solution. It's confirmation that America has entered stage 4, and no empire in 2,000 years has ever escaped what comes next. The mathematics are certain. The timeline is variable, but the destination is written in history.